it might not work out for you. And let me just kick this one off because I already know what you're gonna say.
Okay.
And I'm in agreement with you on this too. I get it that sometimes when people are dollar cost averaging, they're like, oh, I'm buying the dip. I'm buying the dip. But you know what? Whether you're looking at stocks, whether you're looking at crypto prices or other assets, you might be like, it's dipping. Oh, damn, it's dipping again. Oh, and it's dipping again.
It keep dipping and it don't come back up.
Hey everybody, it's Lynnette Khalfani-Cox, the money coach.
And I'm Teri Ijeoma, founder of Trade and Travel.
The show where we break down everything you want to know
about investing.
And probably some stuff you didn't even know you wanted to know about investing.
Yes.
So today's topic is dollar cost averaging, or DCA, as some people call it.
My face is like this. It's a no for me already. It's a no for
right
me.
off the bat, she's like, I'm not feeling dollar cost averaging. I actually am. So you're going to get some differing points of view, obviously, in this session. But let's talk to you about what it all means. What exactly is dollar cost averaging, and how does it work? All right. So first, let me go for giving a little layman's explanation to tell people about dollar cost averaging. So essentially, when you're dollar cost averaging, it means that you're buying a fixed amount of shares or securities or some investment at a fixed interval over time, regardless of what the market is doing. So let's say that you have committed to investing $1,000 a month into the stock market. Regardless of whether or not the Dow Jones Industrial Average goes up 500 points, down 500 points, whether it goes up 1,000 points or down 1,000 points, whatever is happening in the stock market, you are still going to be committed as an investor. You're going to dollar cost average by investing your $1,000 worth of proceeds every single month on a given date, let's say the 15th of the month. I know some people get paid on the 15th, you know, so.
Just got paid Friday night.
A given interval without fail, okay? So let's say it's the 15th. Okay, you're gonna invest your $1,000. But here's the thing. Here's sort of how dollar cost averaging works.
Yeah. Wait, pause. Before you say that.
Yes.
I know some people that actually didn't know like that term. They didn't know the intervals. I think they're saying it wrong. Because whenever I hear about it, it's just, okay, if you buy a stock and it drops down, get some more of it, and the average of those prices is dollar cost averaging.
Yeah.
So
that's a little janky way of doing dollar cost averaging.
So I think some people have been thinking of that wrong for a long time.
Right. So a more strategic, systematic, methodical way to go about dollar cost averaging is to have a set strategy. It's part of your buying strategy. So you know, say I have XYZ stock that I'm interested in, and let's say that stock is $20 a share, for example. And again, you're going to buy 50 shares because that's going to give $1,000 worth of your money that you've agreed to spend every single month, okay? 50 shares times $20 per share is $1,000, okay?
A lot of money.
Very clean and easy. You got that. You spent $1,000. But now, let's say the next month, the stock has fallen. That $50 per share.
Or $20 per share.
I'm sorry, the $20 per share has gone down by, say, 10%. It went down by $2 per share. So now the stock price is $18. So now you're doing your $50. You're buying your 50 shares. Thank you for correcting me here. You're buying your 50 shares, but it's at a price point of $18 per share. What's the math? 50 times 18. We can
do lot.
Wait. I got my calculator. I got my stuff going on right here. It's really not that hard for me to figure out. I really should have known this ahead of time.
So right now we're calculating 50 times 18 because we're trying to see how much this time it'll take. Last month it was 50 times 20, which was 1,000. So now this month it'd be 50 times 18, which is
900.
You saved $100.
Now, I was jiving with you guys. It's a very quick and easy way you could have figured this out. We already said that the price went down by 10%. And we already said that you were spending $1,000 every single month. What's 10% of 1,000? 100. So therefore, you know, next time you're spending $900 on that month too, right? When you're buying those shares. Okay, so, but here's the thing. If you bought $900 worth of stock, and that was in your second month, and then in your first month you spent $1,000, you take the average of the two, you spent an average of $950 to acquire those shares.
No. You spent $1,900 to acquire 100 shares, right? Because it was 1,000 the first month and 900 the second.
Correct.
Okay.
But I'm saying correct.
Oh,
but the average of the two,
right, was $950 per month.
Absolutely, that's correct.
Okay.
So don't let our math confuse you, you guys. We're freestyling it here. We just wanted to tell you how this is going to work out.
Can I give another way of how I think about that?
Absolutely.
So you had 50 shares at $20 in month one, and then you had 50 shares at $18 in month two. So that means that the average is you're buying 50 shares each time at $19.
Exactly.
So now the price there is about 19 versus 20 and 18.
And that's an excellent way to summarize and to recap it. So at the end of the day, this is the whole purpose of dollar cost averaging. You're trying to buy more shares at a lower overall price point on average. So in the example that we just gave you, for example, now you would have all of those shares that you bought for an average price point of $19. And this is part of the reason why people like to dollar cost average. Over time, when they're adding to their position over and over, they're like, if I do this, I'm going to ride out some of the market variations. Sometimes the price is going to be higher, sometimes it's going to be lower, but overall, I'm going to stick to my consistent strategy. I'm going to put $1,000 in there no matter what. And my average price point will be lower. Okay?
Now that's if they invest lower, but what if the next month it goes up? So that's not considered dollar cost averaging, right?
That's absolutely part of dollar cost averaging because the initial purchase that they made, say at $20 a share, if they buy it the next month and it went up by 10% to say $22 a share, their average now is $21.
So it's still lower than the highest amount.
Absolutely. So you're still dollar cost averaging. But some of you might be like, okay, well, why is this important and why does it matter? And I think, honestly, it matters for a couple of reasons. One is that dollar cost averaging, and I see that face. I see that face, Teri. You looking like, tell me the benefits. Tell me why it matters.
Well, and I could also say why it's important for some. But go ahead, tell the points and I'll tell some more points.
So you tell the anti-points, okay? So I think that it's important for a couple reasons. One is that, and we'll go point by point here, okay? One is that dollar cost averaging helps you to be a more consistent, disciplined investor. It takes a lot of the emotion out of your investing strategy. So for a lot of folks, they might be like, okay, I'm gonna buy some today, maybe if the market is doing well, or oh no, the market is selling off, I'm panicked, I'm not gonna buy anything today. And that's not a great way to have buying or selling discipline. So again, part of the strategy behind having a methodical dollar cost averaging strategy is that you're going to be consistent no matter what. You're not going to let your emotions rule the day. So that's one benefit.
Okay, I can see this.
You can go for that one. You can agree with me on that. Okay,
yep,
good. All right.
Yep. And y'all know this is not how I trade because I'm more of a look at charts and get in and out fast. But for those that are dollar cost averaging, I can see also this helps you get a better price. So we talked about how this will make it more consistent. You have, consistent times that you're investing, but also if you are investing at $20 one month and the next month it goes to 10, over time you're going to get that share at a lower price. And then when they do go up altogether, you'll be able to make more money because you have more shares at that lower price.
Right.
So that is a good reason to dollar cost average. So you can get more shares at a lower price.
Another benefit, dollar cost averaging actually has been proven for long-term investors, I understand, not for active investors and for traders, it has been proven to be a viable strategy over time. Why? It's because people are not timing the market. Again, no offense to trading.
Yeah, we're talking about long-term investing now.
Absolutely. So if you believe in a company and if you think, wow, this company is going to do well over time, it's good to add to your position consistently over time. You're buying shares in incremental pieces of that business over time. So your portfolio is growing as the fortunes of the company grows as well.
I like this point because it's about not putting all your eggs in one basket.
Absolutely.
So I like this stock. It's a healthy company. I really like it. But instead of just assuming that I know everything and putting all the money in, I'm going to put a little in now, wait for it a little bit, then a little bit more money, wait some time, a little bit more. And that's nice. That's a wise way to invest.
That's a wise, and you brought up something really important here, because sometimes people get a lump sum of money. They might get an income tax refund check. They might get a bonus on the job.
Yeah.
They might get divorce proceeds if they let that guy go, you know.
Give your ring back. No, I'm playing.
They might get, you know, life insurance money. They might get any kind of a financial windfall. And frequently, it's not advantageous to go ahead and just pour all of it in there into the stock market all at once.
Yeah.
You don't want to have such a lump sum of investments because you might be buying in at the peak. You might be buying in when prices are high and you don't know.
So many people do that. Everything is up. All the stocks are doing well. So they're like, oh, I'm going to invest now. And that's at the highs. Now everything falls. And they're losing all their money because they did put it all in at one time instead of staggering it out.
Exactly.
Yeah.
So now let's offer a little bit of our 2 cents also about like some of the downsides of dollar cost averaging and some of the stuff and some of the ways in which it might not work out for you. And let me just kick this one off because I already know what you're gonna say.
Okay.
And I'm in agreement with you on this too. I get it that sometimes when people are dollar cost averaging, they're like, oh, I'm buying the dip. I'm buying the dip. But you know what? Whether you're looking at stocks, whether you're looking at crypto prices or other assets, you might be like, it's dipping. Oh, damn, it's dipping again. Oh, and it's dipping again.
They keep dipping and it don't come back up.
It keeps dipping and dipping and dipping. So
drop low and you don't come back up.
Yeah, you have to distinguish between, as Teri often teaches in her class, fundamentally healthy companies, good businesses that might be, for whatever reason, out of favor on a temporary basis, or there might be an aberration in the market where the stock price is lower, but not an unhealthy company where it's just falling and falling and falling and falling, you know?
Yeah.
So you don't want to keep buying a dip and throwing good money after bad. So that's a problem I can see if somebody is kind of willy-nilly investing and has a dollar cost averaging strategy and never takes the time to look and say, like, what are my actual returns here? Like, am I just constantly losing money?
If they're doing it with the wrong companies, that can really hurt them.
Yeah.
If you've gotten a company and you're so loyal to that company but don't realize that the underlying foundation has changed. For example, I think about during COVID and airline stocks, there was a time where people were so loyal to, well, I've been in this airliner and this cruise line for 50 years and I don't care if it goes to zero, I'm going to stay in it, I'm just going to keep throwing money at it. I see it also with like crypto coins.
Absolutely.
There's some coins that people are like, oh, it popped $1. I'm going to just keep going, putting money in it. It starts tanking. It's like 3 cents now. And they're like, oh, but wait till it goes up. I'll be rich. But they just keep putting money in it, even though it's no longer a good asset. So yes, you're so right. If it's not a healthy asset anymore, then you're no longer dollar cost averaging. You are throwing money at something that is trash. I'm sorry.
That's harsh. That's harsh, but that's real, okay? Yeah. It's trash, okay? Yeah, I think we can call some of these altcoins and some of this other stuff kind of trash. I mean, it's just like
and you're
throwing good money
hoping,
after bad.
Like,
and,
oh, one day it's going to turn. Well, when is that day going to be? Why do you have to be broke now waiting for it to turn? Like,
that's a good way to look at it. Don't be broke now.
Like, real talk, I love my family, and I know they know that I talk about them sometimes, but like one of my family members, and like I said, I had to repeat, I love my family, y'all. But And maybe, you know what, we're going to pretend it's not my family. Somebody I know has...
So-and-so said, but what happened was...
You know, is rich on paper, but broke in real life. And yeah, this is someone I know, not even my real family. But because they have all this money invested in coins and all these things that they just, oh, well, I heard somebody say this. The coins had gone up, but then in real life, they were still broke. The problem is they didn't want to ever take a profit on their coins. So now the coins have started falling. And instead of just saying, okay, you know what, I'm going to take some profit now, and then when it comes down, I'll get back in at a lower price, they're just watching it fall. And then they're putting more money into it because honestly, it's a mindset thing. Sometimes we don't want to realize that we're wrong
and pull that trigger
and so we just keep putting money at it, and it's like, you know what, boo, you would have been better taking some profit. Yeah, you might get a little bit of tax because it'll be short term.
Sure. That's
fine, but take some profit. If it comes down, get in at a lower price and you'll be able to see that stock rise again.
You can get back into it.
Yes. It's not that if you take some profit you can never get back in. Watch it go down. Be super excited then that it's going down because you took some profit. So now you can get in at a lower price. That's why when I often hear people, and they do it in the wrong context, they just think dollar cost averaging is you put some money in, you buy a stock, when it falls you buy more, and their assumption is they'll have more shares and it'll come back up. So with that strategy, oftentimes I get frustrated because I know that people are not taking their profit when they could have, and they're just waiting for it to go down, which is not healthy.
So, and let's point out something else for our audience to understand about buying on the dip, and then it keeps dipping and dipping and dipping and falling. So just basic math. If a stock loses 50% of its value, it has to have a 100% gain, has to come back 100% or double just to break even. So that's another reason that, as you often say, get out.
Take some profit.
Take some profit or cut your losses, you know, and not be so wed to some of these stocks. You mentioned the either airline stocks or travel stocks, you know, cruise operators, etc. And obviously we've seen everything that's happened with the pandemic. Let's keep our fingers crossed because we both love to trade and travel, you know, but the fact of the matter is we don't know with coronavirus and all these Delta and, you know, Omicron variants and the next one that's going to come along. Anytime some of these travel and tourism stocks can take a hit. Again, I'm not bashing those stocks, but I'm just saying be aware that sometimes what you think might be a temporary dip, it might just be a continual drop. And a 50% drop is actually a very large drop in stock. And again, you have to have 100% gain just to get back to break even part.
What that means in numbers wise is, say the stock was $100 and it comes down to 50. Well, now you have a $50 stock, and in order for it to get back to 100, it has to make $50.
It has to double.
That's doubling.
Yeah.
And in investing terms, remember the average over a year of the stock market is 8 to 10%. So you're asking this stock to double 100% when the normal average in a year is 8 to 10%. That's hoping, not really being logical.
That's a hope and a prayer, okay?
Right?
That's not using good financial wisdom and just looking at past performance. Past performance is no predictor of future, as they always say. However, we want you to take into account some of this stuff to make sure that you're not being financially foolish, okay? So, you know.
And we should have gave a disclaimer too. Everything we talk about is for educational purposes only.
Absolutely.
We're not telling you what to do with your money or how to invest, but this is for education and entertainment so that you'll know more about investing.
That's right. So we're not CFPs, we don't have a Series 65 and all that other good stuff, and so we're not giving you specific investing advice, but we would like to offer you a framework for making really good investing decisions. Obviously, I've written a book on investing called Investing Success. Teri teaches courses on trading and on investing so that anybody who wants to learn can in fact do so. So maybe we talk about now about getting started. If you do in fact want to get started investing, dollar cost averaging and or trading. I'm gonna kick it off to my girl over here because, you know, I've often recommended and suggest that those of you who want to learn the fundamentals about being an active investor, do so through Teri. You know, you can, you're very welcome. You can learn a lot from somebody who's been extremely successful at teaching, not only at earning her own money in the stock market, in crypto and in other asset classes, but mainly somebody who cares about teaching other folks how to learn, how to trade, how to evaluate good companies, how to set your risk profiles, how to understand entry points and exits, how to, you know, do an analysis to determine, is this even worth it for me to put my money into a given stock or not? So that's one way you can get started. You can check out my girl, Teri, and go to tradeandtravel.com.
Yes, and we'll have links below, so you can click the link in the bio if you want to know about trade and travel. Now, let me give you some tips on how to get started with dollar cost averaging. First, I have to preface this. Is it preface or
preface?
Preface.
Yes.
I didn't know. It was like prefix.
Preface, preface, all of the above. You say tomato, I say tomato. It doesn't matter. Y'all know what we talk about. Go ahead.
Right. But I have to begin this by saying, first, you need to figure out what your strategy is. Are you a long-term investor or a short-term investor? That means, are you planning to buy these stocks and hold them for a long time? Or are you getting in and out of stocks for income on a regular basis? If you are a long-term investor, dollar cost averaging is a great strategy for you. It's allowing you to put a little bit of money in each month. It's allowing you to hopefully get a better price over time, because as the stock moves, you're getting some really great months where it's gone down. And then even if you have to get it at a little higher price, you still overall get a better price point for your shares. So as a long-term investor, dollar cost averaging is a great strategy. As a short-term investor, I want you to be more mindful about using charts to pick your entry and exit point. If a stock falls too far down, honestly, it's probably surpassed where you should have got out in the first place. If it's fallen below where your stop would have been, and we can cover that in other classes, or if it's fallen below your trading plan, then I need you to take some profit and then get back in after it's made its move lower. You don't have to just watch your portfolio go down, watch the red, watch your stock lose value, and then say, oh man, it was such a bad decision the first time. I'm going to put some more money into it down here at a lower price. Because that's what you're doing oftentimes when you're an active trader and you're putting more money in at a lower price. You're just giving more money to a bad decision. So that's why I say you really need to understand your strategy, and then you can decide if dollar cost averaging is the right thing for you to do.
Yes.
Yeah. Now pause. I do say that with a caveat. Of course there's times where there's exceptions to the rule. Someone I'm sure heard me say earlier, well, you talked about the airline stocks, and it would have been great to get in March of 2020 when the stocks had gone down to $2 and then it came back up. I get it. I mean, I made 6 figures on American Airlines during COVID. Like, I get it. But the thing that I'm trying to show you is that sometimes it's not okay to put more money towards a bad decision. And I hope you're taking that part from it.
Right.
That's what I'm trying to get across.
And that, I think, is a great point at which we can end. And hopefully we've actually made all this make sense for you, because dollar cost averaging, as Teri mentioned, can be a very viable strategy, mostly for longer term investors. And for those of you who are going to be active traders and active investors, you know, it may not always work for you. So you want to think about right up front, what is your goal? What is your overall strategy? That's how you win at investing, by being mindful, smart, and strategic at the very outset. Hope you guys have enjoyed this session. We'll see you in the next one.
Bye.